Alright, this is a review on Monday the 12th of January 2026. Now this is the daily chart. My joint liquidity is higher. I'm targeting the 26,123.75. That's my joint liquidity higher. I see price moving to buy side liquidity at 25,998 even. And ahead of the session, I did a forecast. It's titled the weekly forecast. You can see the 4-hour time frame, the 1-hour time frame, all on that forecast. I'll link the video at the end of this, so watch that to understand the higher time frame narrative. But just on the daily chart here, before I move to lower time frames for this daily review, my joint liquidity is higher. I want to see price stay above the old new week opening gap, which is here. So seeing a rejection from its high is very good for higher prices. And I want to see daily candles reject this half of previous week range. The bodies remain above it and move higher. Moving down to the 15-minute time frame. This is real time. If you look at the market forecast, by the time this breaker was formed, I was looking for support at the mean threshold to look for higher prices. At that time, we had not yet seen this rally. And I mentioned that the most important array on this time frame, or the 1-hour time frame rather, was a sell side imbalance right here. So I wanted to see price trade to the mean threshold of that bullish order block and rally to that imbalance. It was a sell side imbalance, buy side inefficiency on the 1-hour time frame. We saw that happen sweetly. Moving down to regular trading hours. This is the 15-minute time frame on regular trading hours. Price was opening down here. This is the low. Excuse me for the labeling, this is an error. This is supposed to be open range gap low, open range gap high, lower quadrant, consequent encroachment, upper quadrant. So at the open, electronic trading hours, as we have just seen, is trading off of a bullish breaker heading to the 1-hour sell side imbalance. Regular trading hours is supporting the idea because we have a 70% likelihood of seeing mid gap traded to. So 50% of the open range gap, there's 50% of seeing that traded to at the open within the opening range from 9:30 a.m. to 10 o'clock a.m. New York time. We see that happen sweetly. Price traded higher, and in review we'll see price give a full gap closure at the end. So what's the narrative? We are bullish on the higher time frame. The daily chart, we're looking for buy side. We saw that in the previous slide. Now price opening lower. Opening here is indirectly running sell stops. Launch lows, New York PM lows run out. People who were trying to be a breakout artist on the downside attacked in. Price, they'll be profitable on shorts for a short period of time, but price is running them up. Price is running against those orders and attacking the buy side, trapping them, and buy stops are up here. They'll be targeted. Smart money has accumulated buy stops down here and is running higher to pair them with buy stops. Oh, I said that wrong. Smart money has accumulated sell stops down here and is rallying higher to pair those sell stop orders with buy stops. So if you came to the chart at 9:30 a.m. opening bell, you would not be able to participate in this move. The move I just showed you with the rally higher. That rally was at 9:30 open. The first candle up was 9:28, second 9:29. By 9:30, boom, massive displacement to the buy side. You could not possibly appear at the charts at 9:30 and participate in that move. How to participate in that move would be to be trading in the pre-market session. ICT just dropped a massive lecture, a masterclass on how to trade the pre-market session. He mentioned using the Asian session liquidity. Asia actually starts at 7 p.m. New York time, closes at 5 a.m. New York time. This is the Asian session, not to be confused with the Asian open Q zone. Asian Q zone open will have buy side liquidity here because this is the high of the Asian open Q zone. However, the Asian session is this wide, and Asian session high will be right up here, so it's a very good draw on the buy side. But right here you can see it's trading downwards, and you see a pool of relatively equal highs, matching with this high, matching with this high, and all of these clean highs. This is a very good pool of buy side liquidity pool, a pool of buy stops. So at the 7 o'clock open, we want to see price attack this liquidity. The pre-market session will be attacking liquidity or be framing narrative based on the data, inefficiencies, and liquidity found within this time period, 7 p.m. to 5 a.m. New York time. That is how you trade the pre-market session. If you have not watched that video, I recommend you watch it. It's in the 2026 ICT mentorship or ICT playlist. Moving on. Remember those relatively equal highs from the Asian session? They are delineated here. ICT mentioned this buy side imbalances and efficiency. Right here, it is a reaper. It is the first presented fair value gap after 7 o'clock. He also made mention of the qualities of a first presented fair value gap and the criteria he uses to choose them. He mentioned displacement. Now, what is displacement? He described it as it must be 10 handles on the Nasdaq. Roughly 10 handles, that's the first quality. Next, you must sweep liquidity. We see liquidity being swept here. So a displacement is a move at a specific time that sweeps liquidity. Forming a fair value gap there makes this qualified to be a first presented fair value gap. Drawing that out, you see that price hits the consequent encroachment and produces this beautiful rally to relatively equal highs we saw at Asia. That's a bread and butter setup. It yields 26.25 handles, and your risk there is just 10.75 handles. Asia for the pre-market session, that's good. That's very good. So it's a model that he says is present every day on the charts. You will never need to even trade the opening bell if you have this down to the T. Now, a major criteria for my trading and for a lot of people's trading is a manipulation, especially at opening bell. We want to see a manipulation before an expansion. So the New York ATM model, if you are versed with it, is a run on pre-market lows if we're looking for bullishness. So we want to see pre-market lows get run out, and then we see price run higher. That didn't happen today. And it begs the question, why? Why did price not run lower on the opening range before running higher to take the bullish expansion? There are a lot of answers, but to keep it brief, we are opening in a deep discount relative to the fact that you saw Asian trade down. Asia has traded lower. Price is opening at the opening bell at 9:30, opening at a massive discount. It's opening way lower, so the open range gap is low, and we have a gap up. We have a gap down rather. We trade up to fill that gap, and we trade up furiously and with speed. The manipulation before this run up is a major confluencing factor for why price trades higher without taking pre-market lows. It is in a hurry. The next, there's a phantom trend line. A phantom trend line is a fake trend line. It's a fading of a retail idea of a trend line. So there's a 1, 2, 3 touches. Retail traders are looking at this too long, and you see this meeting low and this taking out ahead of the open though, but they are taking out nonetheless. So this is a liquidity rate. We do not necessarily require this liquidity rate to happen since this has happened. So the sell stops resting below these lows have been engaged. Order pairing will take place, and it is confluencing. Look at the bodies of the candle staying within the first presented fair value gap at 7 a.m. and we see that massive rally higher. I'm not boasting to be in this trade. I was not. As a matter of fact, I took 2 losses today. But this is how to frame such a setup where pre-market lows will not be taken, and you see a rally of logical levels to buy side liquidity when the bias is actually bullish. Alright, now looking at the 1 minute time frame review. Oh, I just forgot the 1 hour breaker. Let me go back to the pre-market range. Could you see this line here, this white line at the end? It says 1 hour breaker. This is a consequent encroachment of the 1 hour breaker. Look at the bodies. This is perfect respect, algorithmic delivery from a higher time frame key level on 1 hour chart, and it is beautiful to the upside. Alright, let's move back to the 1 minute chart. So this is that move up. You see price finally trading to Asian session high after getting mid gap here. It traded to mid gap, retraced, ran up to Asian session high. So after taking Asian high, this swing low forms. ICT actually mentions before he left off stream saying he does not want to see his low taken. Looking back retrospectively, I regret not seeing this ahead of time, because this is a buy side imbalances and efficiency. It's a bullish fair value gap. Getting into it with all these fair value gaps staying open, if price was seriously bullish to the upside and still had some range to go higher, I mean massive range, and it was to deliver that during the silver bullet hour with low resistance liquidity conditions, you will not want to see this disrespected. When we saw this rejection of it, we wanted to just see move higher. Trading below it is a signal that high resistance liquidity range conditions are coming to the market, and that's exactly what we saw. At this point, full gap closure was attained. It retraced down to the upper quadrant of the open range gap, found support at this 5 minute bullish order block, and we saw a rally flipping the new week opening gap. This is the point where things went south for me, because I thought going above this new week opening gap will require a lot, and if it happens, because this is this week's new week opening gap, trading above it will mean higher prices, which I am expecting. So I was looking for long setups above here, and let's just say it's not pan out well for me during the launch session, but eventually it delivered buy side of those levels. So this is the first trade. This trade, price traded above the current new week opening gap. That's my catalyst for longing. A continuation move. We're deep in premium, I know it, but I'm looking for a continuation since we have traded above the new week opening gap. As we're trading down to its constant encroachment for a retest, I was longing. I expect price to stay at the upper half, maximum to trade to the candle. I don't want to trade to the candle 1 of this 5 minute fair value gap. That's where my stop loss is at, and I'm longing, looking for higher prices at, with the 10 minutes at 1.5 standard deviation of that leg down, the retracement before this rally above new week opening gap. At the same time, I'm targeting regular trading IFs buy side liquidity pools. You can see them to the left of the screen. I'm taking them onto the right of the screen now, and you can see buy side liquidity pools outlined there. I'm looking for longs to that level. In a short while, I'm going to add 2 contracts to this position. This is a voiceover, by the way. I'll add 2 contracts to that position when price trades above this current CB. The CB is in orange. I labeled it as an IFVG because I'm expected it to be inverted, and when it's inverted, I'll add 2 contracts on the retest of it, and I'm aiming for buy side. Alright, so now I'm in 2 contracts, and price is trading well at this point, but I don't want to see trade to the inverted fair value gap towards the low. I see that happen right now. Price trades to the low of the inverted fair value gap. That is not what I want to see. That's bearish, or it shows high risk and liquidity run conditions. So I'm looking at this very skeptically, and as a winning trader, you have to be able to cut losses short and see where price is not going to deliver your objectives and start exiting the positions so you don't take large losses. The 1% succeed because they have very big winners. They take the losses up and they cut the losses short. So I just cut off 4 contracts right there, and I still see very poor price action. No displacements higher. Displacement suspension block. So I have my fingers on the trigger. I took 1 contract up there, and the rest hit stop loss. On that trade, I just risked 0.6%. This new trade, this is the second trade for the day. I'm coming in with half risk. I'm risking 0.25%. Buying just 2 contracts, and I'm willing to pyramid if I see low risk and liquidity run conditions. I'm buying the breaker, the retest on the breaker, which is also the high of the 5-minute fair value gap. And I'm doing that because I saw price reject the 15-minute fair value gap to your left, and I was looking for higher prices. I'm still long 2 contracts, and I see a retracement coming down. I'm going to add 2 contracts. So right there on the retracement, I go long with 2 contracts, and I'm long 4 contracts, aiming for regular trading highs. And you have to know this is impeccable risk management. I see bearish displacements. I don't want to see this if we're having low risk and liquidity run conditions. So I'm already contemplating, again, removing risk. I'm contemplating cutting my losses short if I'm going to be out of this trade. At this point, I'm still in, and then I see, after adding those 2 contracts, it's worthy to note that I reduced my stop loss to break even, or to the point in which I entered the market. But they averaged me to where you can see it there. I'm going to see higher prices, speed above those highs. That'll be bullish, and that was to move to the target. The time is 12 p.m. and we're in the macro. I have to see price expand to that macro. Unfortunately, that's not exactly what happens. Price forms this balanced price range, hits its low, and it's still digging deep into it. We see price trade lower, and it's about to take that short-term low. That is extremely poor, and I take 2 contracts off. That's not what I want to see. I try to stop tight, expecting to see higher prices or get stopped out, and eventually I get stopped out. But not before it rallies again. This is a high risk and liquidity run condition, so we see ups and downs. And you see that's a very big up. I think the algorithm will spool up to, because of that momentum, to spool up to the target. So I add 2 contracts back on, and I'm giving it a chance to see if it's going to find support at this balanced price range. However, I'm trailing stops very tight because I know this is high risk and liquidity run conditions. So my risk is extremely small, just 21 ticks. And once again, order flow is not giving, it's creating a barcode, consolidating, so I get stopped out, and that's it for that trade.